Welcome to Dad Gives Advice. My name is Orestes, and in this video, I'm going to be covering cryptocurrencies. I hesitate to add this video to my other videos on investment vehicles because I really don't consider cryptocurrencies to be a good investment, especially for young investors. But I will include it here just to make sure that everyone is aware of some of the pitfalls in cryptocurrencies and some of the issues that are out there. Remember that these videos are for educational and informational purposes only, and you should always seek the advice of a professional before taking any action regarding your investments. First off, I would never recommend investing money into crypto unless you have a very large and diversified portfolio and you really believe that it is the future for our financial system. In that case, you might want to invest a very small portion of your overall large portfolio. But if you're a beginner starting out with a small portfolio, I would stick to the basics like index funds. See my video on that topic for more information. But we're here to talk about crypto, so let's go on to the crypto story. Back in 2008, an individual or a group of people calling themselves Satoshi Nakamoto published a white paper on the internet on something they refer to as Bitcoin. This person or group has not identified themselves, so they've been anonymous this entire time. But gathering from the wording of the paper itself, it seems like they're some sort of computer scientist or software engineer. The Bitcoin paper describes a new kind of digital payment system based on network computers or nodes. These nodes can be any kind of computer ranging from personal computers, desktops in offices, or servers running in data centers. This new way of making payments was touted as a better way than the old-fashioned way of money transfers involving banks and other applications that require a man in the middle to be the guardian of the trust between the parties exchanging money. Nakamoto stresses in the paper that this new method eliminates costly middlemen and what he refers to as the double spending problem. This double spending problem is simply that with money transactions on the internet or through banks or other systems, there may be some costs that the folks involved in the transfer have to incur because the middleman, the bank or the app owner, whoever is enabling the transfer, is taking a fee for that transaction. The Bitcoin paper states that this double spending goes away with this peer-to-peer system where money can be directly transferred from one party to the other without this person in the middle. Some of the costs that these middlemen factor into their systems are anti-fraud measures that they have to employ because they have to make sure that there is an established identity of the receiver and sender of the cash. But put a pin on this statement because later on you'll find that there's some issues with this even within crypto itself. By January of 2009, Nakamoto had completed coding and testing and had begun his program of Bitcoin across at least one node, if not more, and by then had launched the huge craze that has persisted to this day. Here, I'll pause a second to demystify things a bit, just to let you know that cryptocurrencies and Bitcoin and all these systems are simply computer programs running on computers in people's homes, in the cloud, or in data centers. There's absolutely no magic involved. There's no wizard or fairy dust. It's just software running on computers, communicating with each other, and doing mathematical functions in order to carry out these transactions between buyers and sellers. At the heart of the architecture for Bitcoin and other cryptocurrencies like it is something called a blockchain. This is simply a data structure that holds the information for each Bitcoin transaction in a data block. Then each block is linked together in a chain, hence the name blockchain. Each new transaction between sender and receiver is added to the blockchain in such a way that it is almost impossible to hack or fake. So the system itself is quite secure. The entire blockchain holds a record of all transactions, and each block feeds its data into the next block, making each one dependent on the other. In order for a new block to be added to the blockchain and for a transaction to be verified and completed, the nodes on the network all compete on a cryptographic puzzle. This is what's called in the industry proof of work. The first node to solve the puzzle will win the ability to add the new block to the chain. Once the new block is added to the chain, the transaction is finalized and the bitcoins are transferred from the sender to the receiver. As a reward for having solved the cryptographic puzzle, the owner of the winning node will receive some bitcoins for his trouble. This is referred to as mining, and it is how new bitcoins are added to the system. We should note here that there is a built-in scarcity in Bitcoin. Nakamoto made it so that only a total of 21 million bitcoins would ever exist. So at some point in the future, we'll run out of new Bitcoins being created and we'll have a stable supply of 21 million, and the number should not go up from there. This means that as more Bitcoin transactions take place, the puzzles get harder and harder to solve, and it takes more and more computing power to be able to solve them. At this point, the computers solving these puzzles are all in data centers taking a massive amount of electricity, running very expensive graphics cards, and consuming lots and lots of power. As time goes by, fewer Bitcoins are awarded for solving the puzzle. So it becomes a game of diminishing returns for the miners. The arbitrarily enforced scarcity of Bitcoin is lauded as one of its greatest features. There is a limited supply that will never grow beyond 21 million Bitcoins. So this is seen as sort of some kind of internet gold or a new kind of currency gold that can be used as a standard against which other valuable assets or money or goods and services can be measured. The Bitcoin paper states that this creates an inflation-free environment because the number of Bitcoins themselves will never be inflated because they are going to be set to a maximum number. I'll have more to say about this in a few minutes. Besides the scarcity of coins and the elimination of the double spending problem, there are other benefits of Bitcoin that have been touted, and these include things like the ability to make smaller payments possible due to the elimination of the middleman and the double cost issues, privacy or anonymity in peer-to-peer transactions, so-called direct value transfers, immediate settlements, the reduced possibility of identity theft, borderless flows of money, which means people in different countries can exchange value through Bitcoin without having to go through currency exchanges, zero government interference or regulation, secure and transfer-proof transactions, and finally, crypto is supposedly not correlated to any other investment types. On the other hand, there are some downsides to cryptocurrencies, including the following. It's very easy to scam or defraud the unsophisticated investor. People can be fooled into sending money into some fraudster that has sent them an email about, hey, invest in Bitcoin, just send me your money and I'll take care of it for you, and things like that. And they go ahead and do it, and all of a sudden they've lost their money because the person had no intention on buying crypto on their behalf. It's too easy for crypto to be used to fund illegal activities or black market purchases. It's very easy for hackers and ransomware thieves to demand money or demand payment using crypto because it's harder to trace than other monetary transactions. There are no refunds once the money transfer is made. If you bought some product using crypto and the product arrived to your home and it's not to your satisfaction, or it's some cheap knockoff, well, you're stuck with the product and there's no way of getting that money back. There's no way of processing a return. And there's no guarantee that the person that sent you the product is going to reverse the transaction and give you your money back. There's always a chance that some future cryptocurrency might replace the ones that are out there today. And this, of course, would drive down the value quickly of those coins that are out there on the market now. There are other disadvantages to cryptocurrencies, but to me, the Achilles heel of these coins is the price volatility that stems from the scarcity that we talked about earlier. If we go back to the very basics of supply and demand economics that we talked about in my very first video, you'll recall that price is set as an equilibrium point between supply and demand. If you have a steady supply of something that adjusts either up or down with the demand, then the price should stay pretty steady. But in the case of Bitcoin, you have a supply that is limited. We already saw that it's going to be limited to 21 million and that's it. And we have demand that is constantly growing. Each year, more and more people want to get involved in the Bitcoin craze and want to own Bitcoin or want to have a piece of the pie. So because you have a limited supply of something and you have more and more people demanding for that thing, automatically you're going to see increases in the price over the span of the lifetime of that asset. And this is exactly what we've seen with cryptocurrencies over the years. Prices have tended to go upward because of limited supply and more people getting involved in the purchasing and in the making of the transactions. And many times prices have swung wildly due to disruptions in the marketplace. Some people may have made a lot of money in Bitcoin, but the majority of people lost money because of these wild swings in the downward direction. We've seen prices go up during good times and prices go down when there are scandals or other kinds of issues like the recent FTX scandal in which an entire crypto exchange collapsed when it went out of business. The net of all this is that cryptocurrencies are not for the faint of heart, and really they're not even currencies. For it to be an actual currency, it would have to be stable. so that users of the currency can be confident that when they receive Bitcoin or anything else that they're taking in as a payment is not going to fluctuate wildly, so that this week they may have made a bundle because the price went up, but next week they received payment for a product in crypto, but the value quickly crashed, and now they're out several $1,000s or more in the exchange. If prices are swinging wildly due to market volatility, then you really don't have a currency. You have a very volatile speculative asset. And that is exactly what these cryptocurrencies are. It actually turns out that most cryptocurrencies are correlated with the stock market. So if you remember, one of the key benefits that was touted was, hey, this thing is not correlated with any other asset class, so it's a way to diversify your portfolio. Well, that turns out not to be true. When stock markets go up, these cryptocurrencies tend to go up, and when they go down, they tend to go down. And they go down further than stock markets do. Crypto is not as private as once thought. Some smart computer scientists have been able to trace the theft of Bitcoins from exchanges and have been able to work with law enforcement to provide information on who they are, how they stole the Bitcoins, and some arrests have already been made. So much for that privacy and anonymity feature. Oh, and remember that very first benefit that was touted by Satoshi? The elimination of the double spending problem? Well, it turns out that when the system reaches a total of 21 million Bitcoins and there were no more coins to mine, the owners of the nodes that are making money on mining will no longer be able to do so. And the only way they'll be able to make money at that point is through transaction fees. So now you're back to the double spending problem. You're spending on the product you're buying, and you're having to pay a transaction fee to the miners in order to get your transaction verified and your money transfer completed. So ironically, a system that was set up to eliminate this double spending problem eventually will have this problem again as transaction fees come back into the environment as a result of the overall design of a capped number of coins. And I haven't even mentioned the huge carbon footprint that these cryptocurrencies incur. The estimate from 2019 was that Bitcoin itself generated as much carbon footprint as the entire country of Serbia. It's also been quite costly to transact in Bitcoin in the real world. Many times there are clogs in the network and slowdowns, and it might take a lot longer than you would expect, maybe even days, to get a transaction completed, as opposed to just a few seconds when you're using a standard money transfer application that you can download online. In some cases, users of crypto will pay large transaction fees in order to expedite their verification and get their transfers done more quickly. So much for cheap micropayments using crypto. Rather than immediate payment, there are often delays that make it very, very painful to use this system to actually transact in the real world. So the bottom line is that cryptocurrencies aren't really currencies, and they're not really a good investment. They are speculative assets that some people believe are the next level gold in the world, while others think they're a flash in the pan or too early to market. Maybe a new generation of cryptocurrencies will solve the problems that the current batch has without creating new ones. But as long as scarcity is a feature, there will always be wild price swings in this speculative market. So I definitely would not use these as currency, and I would not put my hard-earned money into them if I were a young investor just starting out. Tread very carefully in this space. The swings are wild, and the downside risks seem to be higher than the upside potential. There's also a lot of potential for fraud and a lot of potential for unscrupulous actors to take advantage of unknowing investors because this area is under-regulated by the government. Remember again that the thoughts expressed in my videos are for informational and educational purposes only, and you should always seek personalized professional advice from an advisor before taking any action. Let me know if you have any questions on crypto or if you have any other topics you'd like to see me cover. Thanks for watching and have a great day.